Well, good morning, everyone. Thomas Montgomery here. We get together with our distribution partners most weekday mornings at this time to discuss strategies, tips, techniques, share success stories, and ultimately support each of you. We have two types of distribution partners. We have RVPs and white label partners. Regional vice, and there's no cost to be either. Regional vice presidents compose our leadership team. These are the professionals, the leaders who are developing a distribution network. It's not MLM, not network marketing, not Ponzi, nothing like that. But essentially, they are the leadership team that's developing the white label partners. So that leads us to the white label partners. The white label partners are those who are going out and connecting with the small business owners. So everyone gets paid, they just get paid differently. The white label partners average right about $12,500 per client that is referred in, that enrolls in the access to capital, which of course has no upfront cost to the client, guaranteed capital raise. RVPs make overrides. And so our RVPs on average are making around $2,500 per client referred in by each of their white label partners. But that is not our topic today. Our topic today is to talk about money. So let's step back. When we are applying for debt, when we want to go out and borrow money, what you can anticipate is that the lender would like to be repaid. That's kind of the basic premise of lending money, whether it be a bank or an alternative lender, whether it be an SBA loan or a non-SBA loan, a line of credit, revolving installment, doesn't matter. The lender or the extender of the financing would really like to be repaid. Makes sense, right? You loan me $5 for lunch, you probably hope that I'll repay you. Loan me $100,000 for a business loan and you really hope I'll repay you. So how do lenders go about dealing with that issue of, I'd really like to be repaid? Well, they try to determine, will and can the person, the borrower, repay them? And so just as we've discussed ad nauseum, there are the 3 C's. And there's more than 3 C's, I know, but the 3 main ones are credit, collateral, and capacity, also known as cash flow. So what you and I know are a number of key principles that it seems that most entrepreneurs don't know. So that's why financial literacy is so important. So what's principle number 1? Different sources of capital have different underwriting criteria. In other words, you could qualify for A, but maybe not B. You might qualify for C, but maybe not D. Different sources of capital have different underwriting criteria. So when we come down to the 3 C's, is it ideal to have all 3 of those? Is it ideal for a business to be creditworthy, to have collateral, and to have capacity? In other words, a demonstrated ability of cash flow to repay the debt? Of course. Is it necessary to have all 3 C's to get funding? No, because there's different sources of capital. Not all of them look at all 3 C's. Well, what we're discussing today with the Opportunity Fund dovetails into capacity, otherwise known as cash flow. So let's imagine that the group of us, we have a small group today, 210 of us as of now. The number will probably go up as time clicks on. But let's say that you and I are a really big committee, a lending committee. And so we own our own bank or work for a bank and we have an applicant. So would we want to look at that applicant's ability to repay the money that they're wanting to borrow? Of course. Now, you might say, well, wait a second. We're talking about new start businesses in many cases. So a new start business wouldn't have any cash flow. Well, that is a true statement. However, we need to look globally. What does globally mean? Globally is a term in finance where the underwriters wouldn't look just at the new business, but also at other streams of income that the borrower, the key person, the business owner might have, which could be their personal income, their reserves, their savings, their cash on hand, or even income from other businesses. I remember working for the SBA, and we'd have a lot of clients that would come in that own multiple businesses. And so it became a very complicated set of financial projections, because even though the new business that the client was wanting to borrow money for, in many cases, they had other businesses that could help provide capacity. So in general, what's a good premise? For a traditional business loan, the lender, we'll just call the bank or the credit union, simplified, the bank, would like to see capacity, the ability to repay the debt. Part of that occurs by us creating financial projections. I was just working with one of our clients just this morning. She's in Chicago, Illinois. We're in the process of getting financing to buy a franchise. And so what we were working on this morning was literally her cash flow projections. So her business has not made a single dollar. It's a brand new business, hasn't even launched yet. We're in the process of launching it. So capacity can partially be established by showing in the future, once we have the funding, that money will be coming in and that we can afford to pay it back. So let's tie it to the opportunity fund, which we see on our screen. In some cases, you and I will face the circumstances where we have clients that are insolvent. They're short of cash, and I'm not making light of that, but whatever has gone on in their life with their current business, their prior businesses, their employment, whatever decisions or circumstances they faced, they're broke. They're broke. You and I have the ability to fix that. And so we can fix that with the opportunity fund. Well, why would we care about that? Because it's easy to say, well, let's skip this whole opportunity fund discussion. Let's just go get them funding. And if they have funding, then of course they'll be able to repay it back. A little bit of a fallacy there, though, right? I don't think that many lenders want to loan money with the only hope that the client can pay the debt back based upon money borrowed. So the opportunity fund is a great, valuable, relevant resource that you and I can help our clients who are either insolvent or lacking working capital. So let's talk about bank rating for a moment. I mentioned that in the agenda that I emailed out to each of you, and I did send this flyer to each of you this morning. So bank ratings. Bank ratings is a way that lenders look at the credibility, one of the ways, not the only way, one of the ways that lenders look at the credibility of borrowers, in this case, small businesses, and it's based upon their bank rating. So bank ratings are calculated based upon the average bank balance in the client's, and we're talking about business bank account, over the past 3 months. And the way it's calculated, it's not complicated, but it's a little bit different. So they look at the average bank balance and then they assign a label to it. And there's two parts to the label: high, medium, or low, and then a number. So let's say that the client had an average of $10,000 in their business bank account. That would be considered a low 5. Low because the first digit is a 1. And if we're thinking in terms of whole numbers, 1 is the lowest whole number, right? 9 is the highest whole number. So 1 is low. And then it's a low 5 because there's 5 digits. Ignoring anything to the right of the decimal, $10,000 is 10,000, 5 digits. So a 10,000 average daily balance is a low 5. A $5,000 average daily balance is what? A mid 4, because 5 is in the middle of whole numbers between 1 and 9, and 5,000 has 4 digits, 500. Let's say that we're not very solvent and we have an average of $100 in our business bank account. That would be a low 3. 1, because it's a low number, it's a low whole number, and 100 has 3 digits in it. We are somewhere between irresponsible or unrealistic to think that bank ratings are not relevant. So what you and I can do, because that's the key, the secret sauce that you and I have as technical advisors is we can help small businesses look more credible on paper, not by doing anything illegal or immoral, but we can manipulate, and that is not meant to be a negative word, but we can manipulate or just simply change, if you want, improve the client's circumstances. And the Opportunity Fund is a great resource to do that. So if you happen to run into clients, and I bet you will from time to time, that are light on capacity, that their bank rating is not very strong, I would encourage you to introduce the Opportunity Fund. It's going to help them and it's going to help you because you're going to generate income from it as well. So let's go ahead and go through the Opportunity Fund. And note, those of you that have been with us for a while, this hasn't changed. This is not, oh my goodness, what's changed now? This is just a re-education of a tool that you and I have that quite possibly you're not aware of. I'll take Bruce, for example. Bruce is one of our most successful white label partners, and he's on the webinar right now. Bruce has a client, and we'll just use his initials, AM. So Bruce's client, AM, good guy. He's actually an insurance agent in the insurance field, but AM is, and he's a smart guy, but he's not very liquid. And so in this case, what we've done, and we've already done it, is signed up AM for the Opportunity Fund. We did this just this past week to be able to resolve his working capital issues and insolvency issues. Again, we're not trying to redirect away from the goal of getting AM or any of your clients a capital raise, 100,000 or more, guaranteed, of course, through the access to capital, but we need to be able to qualify for that capital, and part of that is capacity. All right, so let's dig into the Opportunity Fund. The Opportunity Fund is an economic empowerment program to assist small businesses who need an immediate stream of earned income. So when we're talking about this, we're talking about a significant amount. Why is this 100,000? You hear us talk about it a lot. Why is it important that you and I help show that a small business has 100,000 or more bank deposits per month? That puts it at a threshold where it's credible, it's solvent, and it has much more borrowing capacity. You and I would be fools to think that a company with a little bit of income has as much borrowing capacity as a business with greater income. Just makes sense, right? Go try to buy a car, right? If you have a little paycheck, you're going to be able to get a little car with a small car note. But if you have a big boy paycheck, then you can go pick whatever car you want because there's more cash flow coming through to support a higher car payment. Same with houses. Same concept applies. It's analogous to business loans. So what you and I want, ideally, is this a requirement? Absolutely not. We're just talking about best practices. What you and I want is to help clients show, I won't have to highlight all that. We would like to help clients show at least $100,000 of deposits into their business account per month, or at least sales on their income statement. And you and I can do that absolutely through the Opportunity Fund. This is especially valuable because it's not debt. They don't have to pay it back. But let's continue on. So this is especially valuable for entrepreneurs who do not yet have borrowing capacity due to credit and or cash flow reasons. In summary, it's designed to be a hand up versus a handout approach for entrepreneurs needing assistance getting prepared for their capital raise by injecting earned cash flow. Again, it's not debt, doesn't have to be paid back. So let me pause for a moment. We have a lot more to go through here this morning, but any questions so far on why this is relevant? We got the 3 C's: credit, collateral, capacity. Right now, we're talking about that third C, capacity, otherwise known as cash flow, and being able to help our clients, your clients, my clients, our clients look more credible on paper. And one of the things that we can do for them is help them show on paper that they have $100,000 or more per month in sales, even if they're a brand new business, and then also correspondingly increased bank activity, bank deposits, which improves their bank rating. Now, again, if you don't know what you and I know, you look at that and you might say, well, that sounds too good to be true, but it's not, right? You and I have specifically the proven mechanism to help them do that. And there's a number of you that have come aboard, and your business now is showing $100,000 or more a month in gross income. So it's not too good to be true. It's just a process. You and I are masters of the process. Any questions so far? Okay, so let's move forward. All right, so Jeff does have a question before I move forward. Jeff asks, can the client finance the cost? Well, there is no cost. This is not debt. So I failed you, Jeff, and anyone else. This is earned income, as stated clearly here. This is not debt. This is money coming into their business, earned income. Okay, so let's move on to the background. So where did this come from? How did it come to be? The Opportunity Fund is a financial literacy initiative largely built off the SCORE model. I used to be a SCORE mentor. I think quite a few of you used to work or volunteer, I should say, volunteer with SCORE. If you haven't, you can still go do it. Go to score.org, sign up, and you can volunteer your time. SCORE has been around for more than 50 years. And so the Opportunity Fund was created and influenced by current and former SCORE mentors as well as others. Similar to the SCORE model, participants in our Opportunity Fund spend just a few hours per week to help build financial literacy and create awareness. There's absolutely no cost to participate in the Opportunity Fund. So let's talk about the income. So the Opportunity Fund provides the following benefits to the participant. Now there's another layer of benefits to you by using this for your clients, but let's just talk about the benefit to your client. We're looking at around $100,000 a month in bank deposits. And why is that valuable? Obviously improves their bank rating, as we just talked about. It also strengthens their balance sheet and their income statement. It also provides available working capital while we're going after that funding. And again, it's a source of capital that doesn't have to be paid back. When I was working with the client this morning that I mentioned that we're putting together the package for a franchise, we were working on her cash flow statement. And one of the things that wasn't on there was debt repayment. And so we had to revise it, right? Because if you're going to borrow a whole lot of money, we need to budget to pay it back. And that wasn't on her budget. And now it is, of course. In this case, with the Opportunity Fund, it doesn't have to be paid back. It's free money. So more specifically, participants in the Opportunity Fund should recognize around $100,000 a month in gross bank receipts based upon helping just 8 clients. And so this is built off of our white label partnership program, which you're probably familiar with. And so there's 2 primary streams, a number of ancillary streams, but 2 primary streams of income, the $2,500 paid up front, as well as the performance fee on the back end. Those of you that are RVPs, of course, you're getting overrides on this. So that's where it comes into play for you. I guess 2 benefits, right? First benefit to you is using this to help clients get qualified for funding. And the second is it's another income stream. And so for anyone that wants to participate in the Opportunity Fund, they would just email us and we'll send them a packet to review. All right, so let me shrink this down and let's open it up for dialogue. So does anyone have questions about the 3 C's, the relevance of capacity, why lenders would look at a business's cash flow or a borrower's cash flow and capacity, and or how you and I can help small businesses have the capacity to be able to qualify for larger amounts of funding? Who has questions, comments, concerns on this? Because the Opportunity Fund, I think, is an underutilized resource. And so that's why we're discussing it today. I had one of you over the weekend text me. I had 2 clients that he has, and those 2 clients are essentially insolvent, just broke. And so we're going to be plugging both of them, hopefully today, into the opportunity fund. Because if you have someone that's just flat out broke, they have limited borrowing capacity, don't they? For the reasons we've talked about. This can fix that. So this is not a replacement or an alternative to access to capital with a $100,000 guarantee. It complements, but it's true. We have some people that come in just for the opportunity fund and are not even doing a debt-based capital raise. All right, so we have, we're at 116 people now. Who has questions, comments, concerns? Alfred, Andrea, Bernard, Bruce, Collis, Doug, Jeanette, Jeffrey, Kat, Lawrence, Lon, Mandy, Paulie, Pauline, Phyllis, Sonia, others. Who has questions? Paulie brings up a great point that really this can be part of the educational outreach. Absolutely. Absolutely. I agree with you 100%, Paulie. You could run a whole campaign on just bringing people in because of the opportunity fund. I agree. And some of you do. And that's essentially what our RVPs do, right? Our RVPs are out looking for entrepreneurs that are looking for additional earned income, and they're using the opportunity fund. Jeanette asked if the opportunity fund is different than the Chapman fund. And yes, ma'am, it is. The Chapman fund is a loan. It's money, it's debt. It's money that has to be paid back. However, here we're not talking about debt. This money doesn't have to be paid back. So, I mean, I would be encouraging all of you to plug in to the opportunity fund, which again is our white label partnership program. This is just a different labeling of that same program. Who else has questions, comments, concerns? Timothy brings up a good point, and essentially his model is for every client that he enrolls in access to capital, he turns around and immediately enrolls them in the opportunity fund. So it's like a 1-to-1 ratio, and that makes perfect sense, because it's almost rare that a small business that we're working with couldn't benefit from extra cash flow, a stronger bank rating, stronger financial statement. So that is a good point. Now, some of you, like Lawrence, who's on here, deal with larger, more sophisticated clients that may not need extra cash flow. They're just simply looking to take on debt. Speaking of Lawrence, he asked taxes. So yes, earned income in the United States, there's a tax system set by what's called the Internal Revenue Service, the IRS. And so the tax code could impact an individual based upon not only federal taxes, but also potentially state and local taxes. So yes, income is not taxed, profit is taxed. So a client could very well bring in $100,000 a month for 12 consecutive months, 1.2 million, and have no tax liability, Lawrence, because our tax structure for businesses is based upon profit, not income for businesses, different for individuals. Bruce is asking about where the funds come from. Well, what we do is we enroll clients in what's called, Bruce, the Access to Capital program. You did that twice over the weekend. And so when a client enrolls in the Access to Capital program, Bruce, what happens is they agree to pay $2,500 as a deposit, and you could change that, and they agree to pay a performance fee based upon the capital raise. So those two together generate around $12,500 to the Opportunity Fund participant, otherwise known as a white label partner, per client. And if we do that 8 times a month, Bruce, then that puts us right around 100,000. So the participants in the Opportunity Fund are getting paid as a white label partner, like we talked about. And Bruce, you've done that about 100 times in the past 6 weeks. So I think you were testing me probably there on that. What are the qualifications, Phyllis asked? Super simple. Just let us know, and then we can send the Adobe packet over and plug the client in. There is no requirements. We have ex-felons, we have illegal immigrants, We have foreign nationals. The Opportunity Fund is largely unrestricted. Who else has questions, comments, concerns on the Opportunity Fund? Because it's important that you assimilate this. You can decide if you want to make this part of the resources that you make available to clients or not. But I think what you and I can agree is there's a lot of small business owners that are really on a tight budget, sometimes a non-existing budget. They're broke. Well, that's horrible, right? To go borrow money when you're broke is difficult. Is it possible? Yes, but some sources of capital, not all, look at the borrower's capacity, the ability to repay it. And so this is a great way to resolve a lack of liquidity by the business. And this can be applicable to a brand new form business, just as an existing one. Anyone have questions? Alfred, normally you'll fire a few questions at me. Okay, so Mandy has a question for me, so let me get to Mandy. But I'm looking for the rest of you to participate here. Let us know what questions, comments, or feedback you have on the Opportunity Fund. I think it's huge, and I think it's one of the biggest differentiators that you and I have in the marketplace, is that we can not only help people borrow money, but we can also help them have earned income, 100,000 or more a month, that they don't have to pay back. That's a big deal. That's not available going through some loan broker or going down to Wells Fargo. All right, so Mandy has a question, or maybe it's a comment. She says, ex-cons have a hard time getting jobs and borrowing money. And that's true. And we work with a number of those individuals. So she's asking, could this be marketed to them? Absolutely. I think having some targeted campaigns to veterans, to stay-at-home moms, to released felons. I mean, you could go after whatever target market you want. Recently formed businesses. You could target pastors, plumbers, prostitutes. I mean, it's up to you. The Opportunity Fund does provide a needed source of revenue for just about any type of entrepreneur that needs help with capacity. So I agree with you, Mandy. Who else has questions, comments, concerns on the Opportunity Fund? Pauline asked, and yes, I sent this out to every one of you this morning. I think it may already be in your white label Dropbox now that you mention it, Pauline. I don't remember, but I did email this PDF out to every one of you this morning, all of our white label partners and regional vice presidents, reminding you to join us today. So yes, you all have this, but certainly you can cut and paste from it and use it as you'd like. The most relevant application is when you have a client that is enrolled in Access to Capital, and when it comes time to collect their deposit, for example, even though they don't have any upfront deposit, let's say that they don't qualify for any cash funding, which doesn't happen too often, but it happens on occasion, then this could be a way for them to cover their deposit, couldn't it? All right, great feedback. Any other questions, comments, concerns on the Opportunity Fund? All right, Timothy's asking again about overrides. So that's right, Timothy. So you would earn for each client that you enroll in the Opportunity Fund, which didn't cost them anything, you're going to be earning that override, Timothy, that we talked about, that our RVPs, our regional vice presidents, earn. And that's 2.5 points. So let's just do a role play, Timothy. So let's say, Timothy, you enroll me in the Opportunity Fund, and I go out and get a client. I get a client, Mandy. And so then Mandy is needing additional working capital. So I plug her into the Opportunity Fund, and then you're going to earn an override of $2,500 for each client that Mandy enrolls through the Opportunity Fund. And so it could be a little bit, it could be a lot. So the white label partner, of course, earns the greatest income. Pauline asked, which agreement? Yeah, so any of you that are RVP, and if you're not an RVP, let us know. We can get you set up free and easy. But if you're an RVP, what you're going to use to plug people in is the white label partnership agreement. You should have that. It should have been sent to you on the RVP onboarding email. So you would get them signed up just like that, or you can email them, contact us via email, and we can send it to them. All right, so wrapping it up. What you and I do is help small businesses do three things: improve their financial literacy, build lender compliant loan packages, and become credible enough on paper to receive funding. We primarily accomplish that through our Access to Capital program. Access to Capital program has no upfront cost to the client, guaranteed financing, 100,000 minimum. You could make it more if you want. And we help clients get their first tranche of financing in 3 to 5 days. Some of those clients that you work with may in fact have some capacity issues, some cash flow issues. You may want to consider plugging them into the Opportunity Fund to fix their cash flow issues. Why would you want to do that? Because it improves their bank rating, which we talked about earlier. It'll improve their financials. It'll give them some working capital while they're going along. And so, for instance, those of you that are insurance agents, this is a gold mine, right? Because if the client's broke, how are they going to buy a key person policy from you? Number of us, we have accountants, we have attorneys, we have a number of you that are business to business professionals. Well, if you have broke clients, how are they going to buy anything from you? They probably can't. So the Opportunity Fund helps them have the working capital so they can do what they need to do, and then they can buy your stuff, right? Your websites, your coaching services, whatever it is you're offering above and beyond. All right, well, thanks everyone. We'll have a full week of training until Friday. No training on Friday because we're doing that workshop down in Houston, but we'll be here Monday through, well, today on through Thursday. Thanks everyone. See you tomorrow morning. Bye-bye.